in front of it. Tiffany Wilding joining us right now, chief U.S. economist over at Pimco. Fixed income giant actually just released a report that was bullish on bonds and warned of a mild recession this year. I want to get to some of those calls in just a second, Tiffany, but I do want to start off, of course, with CPI, your general expectations, and more importantly, if you can give us any sort of insight into why we've seen this trend of declining inflation.
Yeah, so you mentioned potentially for a negative month-over-month print, and we do think that will be the case. And importantly here, that's picking up the fact that you have seen global energy prices, come off of their peaks that we saw last year. So that is definitely putting downward pressure on inflation. And I would just say more broadly that if you don't get another 50% increase in energy prices like what we saw last year, or a 50% increase in auto prices, you will have U.S. inflation coming down pretty quickly from like 8% to 4%. So the other thing I would just highlight, we think core inflation tomorrow also moderates. We think the 3-month over 3-month pace, could get down to 2.7%. So that's getting closer to certainly closer to the Fed's target.
Yeah, absolutely. And core is what the Fed looks at when you back out food and energy costs. There's now talk about how perhaps it's more useful to look at even a more narrow measure of inflation, which would strip out housing as well as medical care. People are calling it super core. Is that a useful way of looking at inflation right now?
Well, I think you can just look at wages and kind of come to the same conclusion and not have to do all of that work. But if you do look at wages, what you find is that, kind of similar to broader price inflation, wages are, from a year-over-year perspective, they're still running at elevated levels. But there have been kind of some more recent indications that, wages are also, starting to moderate a little bit here. Now we expect there will be a recession as a result of the tightening in financial conditions that the Federal Reserve and other central banks have put in place, restrictive policy. And as the labor market weakens throughout the course of 2023, that would also put some more downward pressure on wage inflation.
Talk to us a little bit here about how the market has been reacting to all this. We saw in the Fed minutes that were released last week the idea that the Fed had some discussions at that last meeting about the market trying to price in rate cuts, in the second half of the year, and the idea that they're concerned that financial conditions might ease a little bit quicker than what the Fed wants it to. Are you seeing that in your own research and in your own sort of discussions that you're having in Pimco, that the market might be a little bit too far ahead of the Fed?
Well, I think that the market will always, sort of look to, the market is forward-looking, so it is trying to judge, the probabilities of various outcomes at any given time, and of course it's, we have a baseline view that you will get the Federal Reserve that'll pause around 5%, maybe hike 1 or 2 more times, and then by the middle of this year, 2023, you will have inflation that's moderated enough for the Fed at least to start talking about normalizing rates back towards neutral, so cutting. It's possible they start cutting by the end of next year. And so I think the market, being forward-looking is already, just pricing in the appropriate, policy probabilities. Now, it is, of course, important that the Fed keeps, financial conditions restrictive today, because that helps, the economy make the adjustment, towards lower inflation rates. So that's the tricky part of what the Fed has to deal with.
How sensitive is the Federal Reserve to loosening financial conditions? I mean, you look at financial conditions today, they certainly loosened given the rally in stocks and the push lower in yields. And why are they so sensitive to it? Does it make it harder for inflation to get to 2%? Is it a case of people just getting ahead of their skis?
Well, so I think you need, some sustained period of tighter financial conditions, certainly in order to bring down inflation. So of course, policy works through lags, and you need policy to remain restrictive, in order to put, the type of, to have the kind of drag on the economy that will result in inflation moderating back to 2%. So of course, I think the Federal Reserve wants financial conditions to remain restrictive, but the other thing here is that if inflation starts to come down more quickly than many expect, including the Fed, then you just don't need financial conditions to remain as tight as long. So, the Federal Reserve came out with a 3.5% core inflation forecast in their SEP, and that seems kind of aggressive, actually. So it's possible that it's okay for financial conditions to ease a little bit as we have, better inflation data coming in.
We'll talk about some of the positioning here. Of course, the big headline on the Bloomberg terminal earlier today regarding Pimco and the big call on that now's the time to buy bonds, something that we've heard from a lot of the big fixed income managers out there here. Give us an explanation not only of why you made that call, but square the circle with this idea here of how you deal with the potential for rates continuing to come down, but still being able to make a good return on a total return basis, at least off of whatever that mix ends up being.
Yeah, well, so I think ultimately, we did say, bonds are back, and that's because I think primarily the interest rate adjustment that we've needed as a result of the higher inflation that we've gotten, in our minds has largely taken place. And that's not only the Fed. We think kind of a 5% level where the Fed pauses seems reasonable given the underlying trends in inflation. But similarly for other central banks, the ECB at 3%, the Bank of England, the Bank of Canada, kind of somewhere in between. That's largely priced by markets. So it's, I think we're not going to see another 450 basis point increase in policy rates next year. So that just means, that bond market volatility is probably going to come down. The more normal correlation between bonds and risky assets is probably going to restore itself. And certainly, at these higher yield levels, that means bonds are attractive again from a portfolio perspective for our investors.